Welcome to Sustainability Talks here on businesstech.co.za. In sustainability circles, green finance has become almost a comfort blanket. It's quite neat, it's clean, and it's really easy to rally around. But the real economy, the one that keeps the lights on and produces cement and moves goods and employs millions of people, doesn't transition at the flick of a switch. And that's really where transition finance comes in. It's probably less glamorous, more complex, and far more contested, and it asks uncomfortable questions. How do you decarbonize industries that can't yet go fully green? Who decides what a credible transition really looks like? And how do you stop transition finance from becoming the next chapter in the greenwashing playbook? So to unpack this, we're going to be joined by two people who really live in that complexity every day. Tsepo Nsane is a transactor in RMB's sustainable finance team, and he's joined by Ndaba Mpofu, who's a managing director and head of financial services, debt and trade finance at BII. So let's get into it. Tsepo, it's so good to have you on, and Ndaba as well. Thanks so much for joining us. Let's just start at the top. When we talk about transition finance, because the term gets thrown about and I think quite interchangeably, what is it? What are we actually talking about? And importantly, what is it not?
Yeah, I think it's quite a good question because it's important to understand the definition of this type of instruments. So basically what it's looking at is funding the decarbonization in hard to abate sectors. And this type of sectors is speaking about cement, steel, chemical sector, power and energy, and even agriculture. And what you are trying to fund there is you're trying to fund technologies that decarbonize these sectors to reduce the carbon intensities within these sectors, because unfortunately for majority of those sectors, there are no green alternatives as yet. They're still heavily dependent on carbon as an input material. But there are ways to reduce that carbon intensity, and that's what actually you are trying to fund. Is you are recognizing the fact that these technologies unfortunately can't be green today. However, work and steps can be taken to decarbonize them as technology matures. So, and it is important, I think, in your question when you say, what is it not? So what you are not funding is that continued operation of this carbon intensive sector. So your funding is not there just to say, I'll keep funding this carbon intensive sector as business as usual, just to keep it running. You are funding, and some of them will phase out, some of them will be transformed, but what you're trying to do is to reduce the carbon intensity as technology develops.
And often in the taxonomy of green finance and sustainable finance, we talk about glide paths and how companies want to get from where they are now in a hard to abate industry, maybe like cement, to a point where they've got a less carbon intensive input into producing cement through their kiln or blast furnace or whatever it is. Ndaba, from where you sit at BII, why has this become such an important part of the toolkit now in helping emerging markets achieve their net zero ambition?
It is really an important area of climate finance from the point of recognizing that if we do not intervene to abate the high carbon emissions, we would never achieve our net zero ambition by 2050. So transition finance is an important element of achieving that global ambition of reducing our carbon emissions. And we do have the well-established area of climate finance where we are already implementing climate-friendly technologies, whereas with transition finance, you are going back to those industries that are critical to our economies, but are still using these high carbon-intensive technologies. And so to help them to move from those high emissions, it's really critical that we provide the financing that enables them to implement these new technologies, as Tsepo has indicated.
So it's really interesting. It kind of lives for me in that gray area of how we get from point A to point B. And I think it's quite interesting to understand then, Tsepo, how one evaluates and decides whether or not this project is truly a transition fundable project. So from an investment banker's lens and perspective, what kind of process do you go through when you look at a project to say, right, this is squarely within that transition funding mandate?
Yeah. So one of the first things we look at is to understand the entity's carbon maturity. Are they measuring their emissions? Do they know where they are? Do they have a strategy to decarbonize? And if they do, what have they identified as those mitigation levers that they want to implement to decarbonize? Because that becomes the basis of our engagement. And for entities that don't have those plans, how do we partner and work with them to develop those plans? Because it is in those plans that we can then decarbonize. And once you understand the strategy, then say, okay, when you look at the solutions, which solutions make sense, which ones can be implemented immediately, in the future, in the midterm, and how can you complement the different technologies? How much do you need in terms of implementation of those technologies, and that funding that you require? Are you going to raise it in the capital markets? And in terms of your normal debt, are you raising any bonds, or is it self-funded? Do you need any enablement and things of that nature? And then once I've identified those, is you then work with the entity to develop a transition finance framework. This is a tool where they identify their strategy, they outline it, but also make clear to the market, these are the type of activities that we have funded. And that framework then gets reviewed externally by an external consultant who then says, this is a credible framework. Because you then use that framework to raise the funding that you need to implement your strategy. That is quite important. But on top of that is continuous monitoring. As we had said earlier, you are funding an entity or a technology that's still going to emit. So, and because you said in the beginning that you want to decarbonize, it is important to demonstrate to the market how the emissions have reduced. That is why one of the things embedded in transition finance is this continuous monitoring and verification, unlike with green technologies where it's day one. And you already know it's green. So you have to be continuous. So those are the type of things that we embed.
It's very much a balancing act, using the data, as you say, and holding companies accountable, but also being pragmatic. And at DARBA, I think sometimes from the outside, there's often the kind of dark green narrative that there's not enough being done. I look at this as more like a bright green initiative in saying we have to be pragmatic. We have to understand that they're hard to abate sectors. They're not going to be able to decarbonize overnight, but here's the plan, and here's how we're going to do it within the straitjacket that many industries still find themselves. So if you look at steel, for example, as well, how do you approach that at BII to ensure that you're getting that balance right, and you're also not enabling a company to just hide behind this and say, right, look, we're doing the right thing, but really it's just a bit of greenwashing?
Yeah. I think for us, it's key that we work with partners like First Rand to ensure that we are providing the right type of funding to companies that have got the correct pathways towards decarbonization. And so sometimes this does call for some technical assistance, for instance, because this is a new novel area. And so for the companies to develop credible plans, at times you do need to intervene. And so in some of the financing that we do, we would then come up with that technical assistance that assists the companies to develop those credible plans. I think it's really going to be important that we look beyond DFIs as well, because the amount of funding needed to achieve this carbonization is quite big. I mean, by some estimates, we need between $400 and $500 billion in the next 5 years to help finance transition in Africa. And so with that level of funding will require a lot of cooperation, not only from DFIs, but also from the private capital markets, to ensure that these companies get that necessary support to achieve the transition.
That's really where this kind of innovation comes in. Say, Paul, from your perspective, maybe you could just share a little bit more about this 2.6 billion rand deal that you've recently concluded. Really hinges on a Moody's validated transition finance framework. To your point earlier, what problems was that framework designed to solve, and why was independent validation so important and so critical to this to give confidence to the project?
Yes, and I think to Ndaba's point, because this is a novel and emerging theme, and with the point that you had made around greenwashing, it was quite important to ensure that the principles of transition finance are there. And we walked this journey, fortunately, with BII, first for us to define our strategy, which fortunately we had, but we had to identify which activities do we see as credible transition activities. And in consultation with the BI, because that helps us a lot, because we had a sounding voice, because I mean, you can tune your own horn, but we had a sounding voice to say, have you thought about this? Have you thought about this? Have you thought about this? And then on top of that, we then required an external assurance to say, is the framework that you've come up with credible from an investor perspective? We already had a DFI view, but what would the other private investors think of such a framework? And you need an SPO or second party opinion on that. So we went through that journey. Fortunately enough, during that time, both IGMA and LMA, the International Capital Markets Association and the Loan Markets Association, issued transition finance guidelines and principles. So it helps us a lot to say, do our principles match with this, what the market would expect? And that's what the SPO provider said, that our principles and our framework aligns with what is expected. And there was even an article that came out from Environmental Finance to recognize us as first hand, as our framework is the first globally to be aligned with this principle that just came out. So at the end, for us, it was quite important to get that assurance, because it is important when you go to the market with such a new and novel instrument in a very highly controversial industry or sector. One has to make sure that the credibility is there and you are funding the right things. I think for us, it was doing the right thing and ensuring that we give the right signal to the market.
May I add to that, like just to note that it has taken quite a while to develop these frameworks. So BII and RMB have worked together over the last 3-4 years to help develop those frameworks. And so it's been a journey. And so we have got to a stage where you, as Tsepo has indicated, even have third-party opinion providers saying, look, this does indeed meet the requirements of a transition finance. And from that point of view, it enables us to then look to the market to say, look, can we work together to raise more funding? Because we have worked over the years to develop this transition finance framework, which is now available for other investors who are interested in this asset class to come in and support this journey.
A very important point that you raise, both on the idea that this has taken time to develop a framework that has been independently verified, validated, is running with the global best practice, and that evolving taxonomy. Because I think as investors, that's the kind of confidence that you start to then develop to crowd in private capitals through our capital markets. $400 to $500 billion US. Was that an annual figure, Ndaba?
That's over the 5 years.
Over 5 years. I mean, it's a staggeringly large number, but also a number that can be to great opportunities for Africa, and unlocking those opportunities as these big industrial sector companies try and meet their ambitious targets to decarbonize. So if we get this right, I think there's a huge opportunity for Africa more broadly. Just maybe a double with your investor hat on. When you look at a project, what's an immediate red flag for you that you would say, no, I mean, this is not something that we could fund via a transition funding framework?
Well, it's important that the project meets the criteria that's been set for transition finance. So it has to be structured in such a way that, in the first place, there's a clear ambition from the project sponsor to align with the Paris Agreement in terms of their transition finance taxonomy. It's important that there's a clear action from the company to say, these are the steps that we're going to take to make sure that our transition plan is successful. And thirdly, they have to be prepared to be accountable. As Tsepo indicated, you have to assess progress along the way. And so if those three elements are there, if there's a clear ambition, there's a clear action plan, and there's accountability by the company, its board, its management, to say, we are going to embark on this journey to transition to lower carbon emissions. That is what gives us the confidence to work with a company. And so that's the way we would do that initial assessment of credibility of a transition plan.
Tsepo, when you look at this from a risk perspective, what kind of risk are investors taking on here, and how might it differ from a typical green funding project, say investing in a REAP bid round, for example, versus something that is clearly very specific to get a once dirty industry into a much cleaner space into the future?
I think some of the risks that as an investor you go in is, one, you'd be seen as almost investing in a carbon intensive sector. And with that comes sometimes some reputational issues, such that someone might think, okay, but you just promoting the uh, continuous operation of this carbon intensive sector, and that's why education is quite important. But also there's a concept in from investors and in banking called financed emissions. So when you fund an entity and that has emissions, you inherit a portion of those emissions, and they are indirect emissions. So for you as an investor, they are called financed emissions. And a lot of investors have made commitments to be net zero from RMB first month perspective. We've also made a commitment to be net zero financed emissions by 2050. However, when you then fund or invest in a carbon intensive sector, you are inheriting a lot of the emissions, and you have to accept that in the initial stages of your funding, you're going to increase the carbon footprint or your carbon budget. But you're doing that deliberately because you're using active funding to promote the decarbonization. Because if you see, unlike with green, if you fund a green activity, it's zero financed emissions, because inherently the asset itself, there is no emissions. But if we want to achieve, as Ndaba has said, the Paris Agreement goals, the 1.5 degree, 2 degree pathways, you have to target these hard to abate sectors. And therefore, the risk that you have to accept is the fact that your portfolio, from a finance emissions perspective, will increase. But with time, you bring it down and bring global emissions down. So those are the type of risks that you're looking at.
And I suppose then it comes back to education, doesn't it? I mean, if you're talking to a pension fund, a large institutional investor, often the principal officer and the trustees say, no, but
Yes.
we want to, our mandate is we've got to invest into new technologies and areas that are ensuring we reach our Paris goals. But it's about saying, you are actually doing that through this instrument, but it's not going to show up immediately. How mature do you think the market is currently, and how much more education, maybe in Derby, you can pick up on this point, because I know you travel all over the continent. Where would you say we are on the maturity curve and spectrum in terms of kind of educating the market as to the important role that transition funding has to play?
We have a journey to embark on this. If we look at the current sustainable bond and green bond issuances, transition finance is accounting for less than 2% of the annual issuances of those sustainable and green bonds. And so that just shows the gap. We have a long way to go to bring the market to appreciate the importance of this asset class in the first place, and to accept that there are credible ways in which they can invest to reduce high carbon emissions. So we really do need to work together, not only to educate, but where possible to also provide incentives, whether it's guarantees, whether it's technical assistance. But at the end of the day, we do need to see commercial capital flowing into the asset class, because DFIs can only do so much. But our role is really just to help to develop that asset class, and then as the asset class develops, attract more capital into funding its decarbonization activities.
Yeah, very catalytic role that you are playing. Tsepo, what are you seeing in the South African market in terms of an appetite and maturity when it comes to understanding the role that transition funding has to play in the broader ecosystem?
Yeah, and I think there's an opportunity, especially to Ndava's point, is that DFI catalytic effect is quite real. If you look at renewable energy, for example, it was driven a lot by DFIs in the beginning, but if you look now, the private sector is almost taking over, private capital is taking over to a point that DFI enablement is no longer necessary. The market has matured in that regard. So I think with transition finance, we are at the same stage as renewable energy 10 years ago, 10, 15 years ago, where there's a lot of catalytic effect that needs to happen. There's a lot of education that needs, and understanding, especially institutional investors, to understanding that a lot of these sectors, if you don't fund their decarbonization, they actually are a going concern. You can't say they're a going concern, because now their revenue will be compromised. You have things like carbon pricing that has come into play, carbon tax. We have carbon tax in South Africa, and a lot of African countries are considering a tax on carbon emissions. So it becomes expensive, and with that comes an impact on EBITDA, an impact on returns, and therefore institutional investors, those pension returns now gets compromised.
Export markets,
Yes.
CBA.
Exactly. It's starting this year in Europe. Other countries are also considering it as well. The UK has a similar program coming next year. So now you're becoming uncompetitive. So now the question is, for trustees would be, institutional investors, why are you still in sectors that are carbon intensive and not transitioning? Because now the returns will be compromised, pensioners' monies will be compromised, and therefore that education and that connecting the dots is really quite important, both in South Africa and in the rest of the continent. But fortunately, what you're seeing is in some of these countries, governments are already starting to educate. We have a taxonomy in South Africa, Ghana has a taxonomy, Rwanda has a taxonomy, where they're trying to define to the market what it means to be green, to transition in their country. So you can already see that government is enabling, and a lot of them are actually doing those taxonomies with the support of DFIs. So DFIs are not only funding, but they're also educating and working with local governments to ensure that the governments themselves are ready. And that's why you see a lot of these taxonomies coming through. Now it's a matter of the private sector now following through.
And I think a lot of that private sector follow through comes on the back of having good data, doesn't
Yes.
it?
Yes.
And Dawa, if you look at it, that's where monitoring and reporting and holding companies accountable really matters. So what does that look like, that journey from where you sit? And what kind of engagement do you have with the company or the sponsors through the program? Because often these are multi-year programs to develop new power sources or new technologies in hard to abate industries like cement.
Yeah. So that brings the point of reporting into the limelight, because you really need to assess, as Tsepo again indicated, progress along the way. And so we have clear reporting frameworks that we agree with our project partners to say, if this funding goes in, this is the journey that we are on. This is the reporting that we'll be expecting to see during the life of the investment. And that reporting, sometimes supported by a third-party opinion, again, that validation becomes important to say, this is what was agreed as we embarked on this journey. These are the milestones that we have achieved along the way. And so we spend a lot of time agreeing with our partners and our investees on what kind of reporting we are going to receive to show the progress against what has been agreed at the beginning.
And Seppo, maybe you could just give us an example of what kind of project you're looking to fund, and then just zooming out 10 years time. I mean, you said we're probably about 10 or 15 years behind where the REAP program is now. What does that look like in 10 years time if we get this right and we start to mature this up the value curve?
So what you look at in that scenario is obviously the company itself has given you a pathway to say this is our starting point and this is where we want to end up. So now when you fund a project, you then say, okay, how does it enable this pathway? So how much does it contribute on that pathway? Once you have that number has to be quantified every year. For example, in the cement sector, you'll be funding alternative feedstocks, sustainable feedstock integration of renewable energy into a cement plant, because then they move away slightly from coal as a feedstock, especially from an energy perspective. They change their feedstocks to alternative or waste material as a feedstock instead of just raw material in itself. And then what you're going to start to see is the energy intensity and the carbon intensity of that product is going to come down, right? Obviously, as you said, that project is a multi-year. So year one, you're expecting a certain reduction. Year two, year three. So I think what we are trying to achieve 10, 15 years from now is the respective intensities that have been predicted for cement sector, for iron and steel, for aluminium, for the chemical sector. There's very specific emission intensity that are expected along a 2-degree pathway and a 1.5 degree pathway. So what you are looking at is in the 10 years time, at a minimum, at least a maximum, we should be where those thresholds are sitting, and at best below those numbers, because then we are guaranteeing that we are reducing emissions in line with climate predictions. So that's what the monitoring is trying to get you is, let's get on that pathway and where possible, be much more ambitious, because then at least you are promoting decarbonization.
And I suppose, Ndaba, for you, success will probably be developing a world in which your capital is hardly required because you've got such a strong private capital demand for this kind of funding.
Indeed, that's our big ambition, and which is why we've also partnered with RLB to say, let's embark on this journey. And as we embark on this journey, let's help to unlock further capital to come into our financing transition. That is really the sweet spot for us, and we will continue to work with our partners to help to develop that asset class. And from the work that we do, we are really looking forward to seeing more people coming in, not only other DFIs, but also private capital coming in and supporting that journey.
Well, it's great to see such a pioneering and catalytic partnership unlocking this kind of innovation in these hard-to-abate sectors, because I think this is exactly where we need to, certainly as an emerging market and as Africa more broadly, be focusing a lot of our attention versus maybe some more developed markets that are a little bit further down that road. And it's these kinds of partnerships that will hopefully grow that broader capital markets interest. So thank you very much, Ndaba Mpofu and Tsepo Nsani, for joining us on Sustainability Talks and giving us a crash course on what transition funding really means.